about a question that was on the exam for a second, the midterm. So there was a question where I asked you to calculate the cost added to production in March. And a lot of you did the same thing for raw material. So I just wanted to make sure you understood added to production. I wanted you to understand the difference between purchases of raw material and costs added in production. So when we did the schedule of cost of goods manufactured, we started with the direct material inventory, right? What was in inventory? So let's say we had a $10,000 worth of raw material. And then we purchased 5,000. And then we had, so in the schedule, then you have raw material available for use, right? So that's how much raw material we have available, which is 15,000. And then in the schedule, we subtract what's left in the raw material inventory, right? So we subtract the ending raw material inventory. So let's say in our instance, our ending raw material inventory is $3,000 worth of raw material. So that means that the direct material used in production is $12,000 worth, right? Does everybody agree with that? Okay. So the question is, if I purchase 5,000, did I add only 5,000 to production? Was the inventory amount important or not important in the calculation of how much material I added to production? Like, I know a lot of you guys just added, in the question that I gave you on the exam, it was 180,000 that was purchased. Do you remember that question? It was a long time ago. So a lot of you guys just added the purchased amount. So can somebody explain to me why when we do this and get this number, it needs to take into account what we started and ended up with in inventory? Do you know what I'm asking?
You've used up what you bought.
Right?
And in this case, your amount of stuff that you had on the shelf is now less. So that amount less was used for production.
Good explanation. So I had some on the shelf. I used all of what I bought, plus I used some from on the shelf. So when I'm calculating this, this is the amount that goes into WIP, right? And so the amount that goes into WIP is what's added to production. So whenever we do a question where I ask you what gets added, I want you guys to make sure you think about the inventory accounts and what gets moved back and forth. Okay? All right. You're a very good explainer, Thomas. All right, chapter 11. Chapter 11. We are going to start with segment reporting. So we talked earlier, I'm on page 475. So we talked in another chapter about the fact that for management to make reasonably good decisions, they need to have information in a way that that it makes sense to them. That's one of the reasons why we just studied variances, right? Because we want to know how to break that information down so that it's useful and we can attack the problems that we have and make sure we do more of the good stuff that's happening. So segment reporting gives us more information than if we just have a big income statement. So for example, we've looked at a lot of income statements where, say, I think there was a company called Freeze or something like that, and they manufactured popsicles, right? And we had like sales information and cost of goods sold, and then we had other expenses. Well, what happens if in addition to popsicles, they also made fudgicles, and let's say they make ice cream cakes, and let's say they make regular baked cakes. So not ice cream cakes, just regular cakes. Okay, so if we only have our sales for this company as a whole, then if they have a loss, which I think is the example they give in the textbook, how do we know where the problem is? Is the problem across the board? Are all of the divisions suffering? Are they all experiencing some kind of problem? What is the likelihood that the negative impacts that a product might have, like, for example, popsicles and fudgicles? Let's say there's a shortage of freezer, that stuff that you put in the freezers that makes it really cold, Freon or whatever they use. Let's say there's a shortage of that. That might negatively impact the cost. Your costs might go up for these things. Do you think it's going to impact the cost for the cakes? Maybe. It depends, right? Maybe you need more information, but maybe not. So breaking down this kind of information into what they call segments gives the company better information on what to do with its different divisions. So if you look at Exhibit 11.1 on page 476, you can see that they've taken an income statement, and the first top it says segments defined as divisions. So in this part of the example, the top section there, it says they've got this company, it's got $500,000 of sales, and they've broken it into business, products, and consumers. So business and retail, right? That's a normal division. But then what they've done is they've said, okay, well, consumer has more than one kind of product. So consumer sells computer animation and computer games, and those are completely different. So they've broken it down into that way. And that second piece, it says it's defined, the segments are product lines. And so they've broken that information down by the product line. And then they've taken the computer games and they've broken it down into the type of sales that they have. And they've shown them in the bottom part. So what they're basically showing you in this exhibit is that you can use segment reporting to break something down into whatever pieces help you make your decisions better. So you can do it to define divisional information and what to do between different divisions. You can use it within a division to break down into products, or within products to break down into its different sales components or whatever. So it's very useful, and you may be asked to do a question that would ask you to break it down into any of those, right? Obviously you'd be given the pertinent information, but it's not restricted to one thing. So the important thing about segment reporting is you can see that it uses the exact same variable contribution format, right? So you end up with a contribution margin. And then if you look in Exhibit 11.1, right underneath the contribution margin, there's a line that says traceable fixed expenses. So what are traceable fixed expenses? Well, it's pretty self-explanatory. Traceable, fixed expenses means that they're fixed. So they don't vary with the amount of production, right? They're fixed expenses. But they are traceable. When you are talking about segment reporting, a traceable fixed cost means if you eliminated that product line, that division, that whatever you're segmenting by, if you eliminated that segment, that cost would be eliminated. So an example of a fixed traceable cost would be the rent that you pay on the popsicle storage warehouse. Okay? It's specifically for the popsicles. If you eliminated the popsicle line, you could sell that. You could, if you rented it, you could stop renting it. It's only needed for the popsicles. It is traceable to the popsicle line. Okay? That's an example of a traceable fixed cost. So in segment reporting, what we do is we assign costs to the segment, which is what it says in the middle of 477. We do it the exact same way that we would do it in a regular variable income statement, except we include that fixed, traceable fixed expenses. And then there is something there called a segment margin. So it tells you how profitable or unprofitable that segment is before you allocate common costs. So common costs are things that the company has to pay for that are usually allocated to all segments. So for example, head office expenses. Head office expenses don't have any kind of product that they can offset, that they don't have revenue to offset their costs, right? So the way that head office costs are handled in every single company is that they somehow allocate them out and spread the costs over the profitable segments. So, for example, at the university, you have different faculties, and each faculty has students that pay tuition, and those faculties would get that tuition, let's say in a simplistic manner. However, the registrar's office doesn't have revenue, but they incur costs, right? So does the human resources department that hires the teachers or whatever. There's a whole huge support staff here whose costs have to be consumed or offset by some kind of revenues, right? So they would pool, they would come up with some kind of total number and then some arbitrary formula to allocate those to the revenue producing. Those are called common costs, and you see them underneath the divisional segment margin, underneath the product line segment margin, underneath the segment margin, that's where those common fixed costs go. And you can see that on the left-hand side, you've got the total costs for that division or product line or whatever it is. But those common fixed costs do not move over to the segment. The segment report ends at the segment margin. You see that? And the point is that there is no value when you're trying to determine the profitability of a segment in including those common costs because they're not actually being caused by the segment. So it's irrelevant data. The point is, if you eliminate that segment, those costs still will be incurred. Okay? So that's why we don't need to include them or want to include them in a segment analysis. So let's see here. They say the contribution margin is basically a short-run planning tool. It's useful for decisions relating to temporary uses of capacity, special orders. But the comment that they make is that by looking at the segment contribution margin, the manager can make better short-run decisions, like a special order. And that's something we're gonna look at, I think that's in, yeah, chapter 12. We're gonna look at special orders. So if, for example, the Freezy division could make a special Freezy for my company's golf day, and we would pay them $3 a Freezy, but normally they charge, $4. Can they make a profit on that special order? Well, they would know that if they knew what their traceable fixed costs were and all that other stuff. So it helps them make those kind of decisions better by giving them that kind of information. Interesting information about the importance of fixed costs. You should read it. So traceable fixed costs, I've explained to you, they're the ones that would go away if the segment were eliminated or if the product were eliminated. And a common fixed cost is one that isn't traceable to any particular segment or division or product and would not disappear if you eliminated that segment. Okay? And they give you some examples here. And you want to read those examples because you're going to need to, in questions, identify when you're doing these what would be a traceable fixed cost and what wouldn't. Yeah, in fact, it says here on 479 under the title Identifying Traceable Fixed Cost, the distinction between traceable and common fixed costs is crucial in segment reporting because traceable fixed costs are charged to the segments, but common fixed costs are not. They say in actual, it's hard to distinguish them, but in a question, they'll be pretty obvious. Okay? So the general guideline is to treat traceable costs as only those costs that would disappear over time if the segment itself disappeared. And then they give you an example using a division manager's salary. So if that division is eliminated, obviously you wouldn't be paying that manager's salary. Breakdown of traceable fixed costs. What are they trying to get at here? I have a big check mark there, so make sure you read that. Yeah, there's a section here called activity-based costing on page 480, and it talks about how some costs are easy to identify as traceable costs, and then they give you an example where they say, for example, when you're advertising Crest toothpaste, clearly the advertising costs are traceable because it's obvious, right? But for example, now they talk about leasing a warehouse to store their products. And they say, well, if the lease is traceable to the product, then it's traceable, right? But then they talk about, however, suppose at the bottom of that whole section, it says, suppose the company owns the warehouse. Well, if you own the warehouse and you can't use that space, then it's not really traceable, even if it's being used for that product. If you have no other use for it, then it's actually a sunk cost, and it's a common cost, and the cost doesn't go away. So that is the real bottom line to whether it's traceable or not. If the cost will not go away, if you eliminated that segment, it is not traceable. Segment margin, it's obvious how you calculate that. So be able to produce a segment margin income statement like any one of the three pieces on Exhibit 11.1. I would never ask you to do a breakdown to that extent because that's just a waste of time. But you should be able to do one if I give you that information. The more likely type of question you would get rather than to prepare this kind of income statement would be to take an income statement like this, be able to tell me, or no, actually, the most common kind of questions you'll see is where they give you an absorption costing income statement and a lot of information. And you have to be able to take that absorption costing statement and massage it into a segment statement so that you can determine whether the absorption costing statement is telling you lies or not, okay? So let us do a problem in chapter 11 on segments. Wow, I was being tough. I've got a note in here. Tell them to do review problem number 2 on transfer pricing on their own. So clearly I'm not going to do a transfer pricing problem. So let's see, let's find a good segment statement. Okay. Let's look at page 515 at the review problem number 1 about segmented statements. Page 515, review problem number 1. And you definitely want to do some problems about segments because it will be tested. Okay. So it says that the business staff of the law firm has constructed this report, and they've broken down family law and commercial law, and it looks like family law is taking a hit at $4,000 in the hole, and commercial law is doing fantastic. It says, however, this report is not quite correct. The common fixed expenses such as the managing partner's salary, general administrative expenses, and general firm advertising have been allocated to the 2 segments based on the revenues from the clients, which is a common way of doing it. There are numerous ways you can allocate costs. Some businesses like to allocate rent, for example, based on the square footage that each division takes. So is that right? Who knows? I mean, it depends on the situation and whether that's a reasonable allocation. So required, it says redo the segment report, eliminating the allocation of common fixed expenses. Would the firm be better off financially if they dropped the family law segment? Because that's what people want to know at the end of the day. It says, note, many of the firm's commercial law clients also use the firm for their family law requirements, such as drawing up wills. So we want to take out, it says, the managing partner's salary. Do they give us that information? Then it says, blah, 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 blah. That's fascinating. Where do they actually tell you what they are? Oh, common fixed expenses. Yeah. Okay, so basically what they're saying is, and I don't even really need to write this down. So they're telling you that the common fixed expenses, so in a general segment report, what would be the difference between what they've done and what we would do? So the revenues from the clients, would we change that? No. The variable expenses, would those change? No, because that's exactly what we would do. Then they get a contribution margin, and then they have their traceable fixed expenses. So they've even told you that's the amount of traceable fixed expenses. So that would stay like that. Then they've got your segment margin, and what they're telling you now is this is the way they allocate the common fixed expenses. You would basically stop your margin report before you put down the common fixed expenses. They would stay, so if this is total, or you could put company or division or whatever it is that you're breaking up, and then here's family law and commercial law. Your common stay here, and and don't drift across here. So your segment stops here. So where are they at? Their segment margin for family law is $20,000. And their segment margin for commercial law is $90,000. So the question is family law actually running at a deficit? No, it's not. It's actually contributing $20,000 to the costs. The real problem here is that the common costs are being allocated in such a way that they're taking over more than the revenue that these guys, the segment margin that they have. So both these lines are profitable. So if the question was, should we drop family law? The answer is no, because you don't know that the allocation of the common costs is relevant to this line. Like, this is the important number. Both these lines are profitable. Maybe the answer is we need to look at the common costs we're incurring and possibly reallocate them, possibly cut them down, but this is a profitable segment, so we should not. So if the operating income in this question ends up being $50,000, and you drop this segment, what would that mean? That means your operating income would go down. And how do I know that? This is the real test. How much would my operating income go down by? It would go down by $20,000. Because if we didn't allocate this across here, these are common costs. They don't go away if you drop a line. So now what happens is if we drop this line, we're now going to be dropping $20,000 of profit, and we will only make $30,000 profit because the $90,000 here will have all of the common costs allocated to it, and we will have a net income of $30,000. Make sense? So at the end of the day, if your segment or product or division has a positive segment margin and you drop that segment product, whatever it is you're segmenting, your operating income will go down by that margin. Make sense? Okay. Okay, let's do a real problem, because this one was really... It was a good review, but not a real problem. Okay. So let's try... Boy, there aren't a lot of questions about segment reporting. Okay, let's do 11.2, segmented income statement. Bovine company who makes umbrellas has been experiencing losses for some time. So they've got sales of $2 million. They've got variable expenses. I'm on page 519. I'm doing exercise 11-2, 792. Their contribution margin is 1208. Their fixed expenses are 1305. And they have an operating loss of $97,000. So, in order to isolate the problem, they've asked for an income statement segmented by geographic market. So they've got that information there. So this is going to be the company. And now we've got South, Central, and North. So if we're going to do a segmented statement, we've got to get our segments beside our total, and then we're going to move those numbers out, and all these numbers are going to add up to that. So they've split up the sales into 600, 800, and 6. Okay. Now my variable expenses, okay, they've given me percentages. So what's 52% of 600,000? Somebody have a calculator? 312? Yeah. Okay. Which means this is 288. That's my contribution margin. And then what is 30%? Oh, 8 times 3 is 24. So this is 560. And then this should be, oh, okay. And so that would be 360, right? So then they've got traceable fixed expenses. So these are 320. So now instead of fixed costs, we are actually going to move this. So our operating loss is 97,000. And our fixed are, what? 1305. So now we've got, so this is our contribution margin. So this all stays the same. So now what do we have in our format? What's the next thing that I need to do? What do I need to put up here? What's next? Traceable fixed costs. Okay. So what are those costs? Those are costs that will be eliminated if we eliminate the segment, right? Traceable means that if we get rid of the segment, we get rid of those costs. So the traceable fixed expenses here are 320. 320. So underneath that, that means this is our segment margin, right? So what's our segment margin here? It is negative something, 1232. So that line is not contributing to our profit. It's in fact contributing to our loss, but it's not all of that loss. So this is 530. So this one is actually going at a profit, which means we know that this is the other one that's, oh, how come this doesn't work? Okay, so this one's at a profit. So where are the other, don't look at the question. Tell me, how come this and these are not the same? And so how much are they? Pardon? How would you calculate the common fixed costs if you weren't given them?
Total operating income. This year's operating
that right?
Your total,
So my total fixed costs in the first one were 1,305. And we had 320, 530, and 300, right? So this adds up to 1,150, is that right? Because in reality, the common costs, if we're operating at a loss, the only thing left is the difference between here and here. Because this is giving, oh yeah, no, these are going to throw us off. So the common fixed costs are the difference between these and this number here, right? 1,305. So what's that number? What? 155? Okay, so $155,000 of those costs will not go away if we drop any segment line, right? We're stuck with these. But all of these traceable fixed costs. So my question to you is, if they have an operating loss of $97,000, what will be their operating loss if they drop this line? What will be their operating income if they drop this line?
would be the 30 and the 60.
65,000?
And what would it be, income or loss?
Lost.
90 less than.
Because this is only 32,000 of it, right? So they're gonna have a loss of 65,000 if they drop this. So even though these guys are operating at a profit, and their losses would increase if they drop either of these two lines, their common costs are too much, right? Their common costs exceed their profit, right? And that's why they're having a loss. But if you eliminate either of these two segments, your loss will get bigger because these won't go anywhere. You will continue to incur them even if you drop all three lines. Okay? Okay.
So the common fixed cost is 155.
Yeah.
Yes.
Will we be asked to allocate into South Central and North?
You don't allocate the common fixed costs though.
What? Are you saying, would I ask you to create this?
Would you ask us to break down 155 into the 3 segments?
No.
That's the one that you never break down.
That's the one you never break down.
Oh,
Tammy is
okay.
correct. I mean, they show that on an absorption costing statement, and you might get an absorption costing statement like the one we had here, where they had it all allocated out, right? Where they had 1305000, and then they might have somehow allocated it out by fixed costs, 50,000, 50,000, and 5,000, and then their absorption costing statement would show this as a loss of 87,000 and a loss, or this would have a profit of 3,000, and this one would have a profit of, So I would, it's more likely a question would show it like this, and you'd have to pull this out, right? is basically the things to take away from this are that traceable costs are eliminated when you eliminate the segment. Common costs are not eliminated, are just redistributed if you eliminate a segment. And that the amount that the operating income or loss will change if you eliminate a segment is by the amount of the segment margin. Because everything below it doesn't vary with how much you produce of anything. And I'm sorry there aren't very many questions about segment reporting, but I think you guys understand it very well. So let's go on to that wasn't very good. Read responsibility centers on page 484, but I'm not going, there's nothing for me to, you know. So read that. Transfer pricing on page 485. I love transfer pricing. Okay, this is testable. It will be tested. Let's just get to the chase. Okay. So transfer pricing is something that occurs when a company has more than one division or more than one product, and one product is used to make another product. So for example, if you have a company that builds containers, and they also build freight cars, and the containers can be used to build a freight car, or they make buckles, and the buckles can be used by the department that makes suitcases. Then basically you have a situation where one department is manufacturing something that can be sold on its own to outside parties, or it can be used by inside by another department for the company. So then the question is, if you evaluate managers on their profitability and their revenue comes from another department in the company, then the question has to be asked, who gets to set the price for that product? Because obviously the department that's selling it wants to get as much as they can get for it, but the department buying it wants to pay as little as they can if they're being both evaluated on their profitability, right? So if, for example, the cost for me to manufacture my suitcase is $50, and in that $50 I pay you $5 to your department for that buckle, if I can get the price down for the buckle to $2, I make more profit. I would get a bigger bonus, right? So there is a constant tug of war between the selling and buying department as to what price is the right price. And that price is called the transfer price. It's the price for transferring the good between the department. So transfer pricing is a huge, huge business, because there's taxes that are paid international companies. For example, let's talk about Tim Hortons. Tim Hortons has a manufacturing company for their coffee, right? And they distribute their coffee to all the different franchises, and Tim Hortons Canada might distribute to Tim Hortons in England and Australia. And if they sell the coffee to the Tim Hortons in Australia, and the taxes for the coffee are higher in Australia, then the amount they pay for the coffee, for the company, it's actually better if they pay more for the coffee in Australia than they might, because it reduces their revenue, Like their revenue is how much they get for selling the coffee to the consumer. If they're buying the coffee, then that reduces their profits and you're taxed on profit, right? So internationally, do you understand where I'm going?
Yeah, but I'm just thinking that it seems almost a moot point in the end because it's the same company. They're not, like you're saying, they're selling it to themselves.
Yes, but when taxes come into play, that's the external piece, right? So yes, you are exactly right, and that is what a lot of the questions that we will do will be about. The question is it better for the company for this transfer to take place or not? Because departments may say, if I can't buy this from you at this price, I'll buy it externally. And if they have the authority to do so, they could actually make a poor decision for the company where the company overall would make more profit if they did the transfer because it costs them this much to manufacture. But in the example I'm giving you, I'm talking about how internationally, if one arm is selling to another arm and this reduces their tax because this is a higher tax, and so if they can reduce their profits, they'll pay less tax, that benefits the company as a whole, right? It's a big, huge international conglomerate. So there's a lot of activity, legal and tax rules and all that kind of stuff about transfer pricing. But that is actually the root of this whole transfer pricing issue is it beneficial for the company and will the managers make the right decision based on their opinion and their, benefit, right? So if you look at page 486, there's actually, at the top of page 487, it explains to you how transfer prices are set. And it's really common sense, right? So it talks about capacity. So let's actually, the definition for a negotiated transfer price is the transfer price that's agreed upon between the buying and selling divisions. Again, that's just common sense, right? So if you look at the two numbered items in the second paragraph there, it says you cannot predict the exact transfer price they're going to agree on because personalities will always come into play. But as a general rule, you can state a range of transfer prices, right? So the first thing it says is that the selling division will only agree to the transfer if the profits of the selling division increase as a result of the transfer, right? So in the example I gave you, if I can buy something externally cheaper than I can get it from my alternate division, I as a department manager or a division manager would choose to go externally, right? So that's a basis that we're going to use for determining transfer price is if I make a profit, I will do the transfer. And that the purchasing division, sorry, that was the purchasing division. So as a buyer, I'm only going to transfer if my profits increase, and as a selling division, same thing. If my profits increase, I'll do it. So if, for example, so what it comes down to is the variable cost to manufacture. So if I can manufacture ball bearings for $2, so the variable manufacturing costs, I'm just going to put variable costs per unit are $2. So I will not sell my ball bearings to anyone, no matter whether they're in my company or outside of my company, for under $2. Correct? Like, why would I? I won't make any profit then. So the minimum selling price for me is my cost to manufacture. So that's $2. And the minimum selling price is always set by the seller of the transfer. Okay? So that's the minimum. What's the most I would take for my ball bearings?
Whatever someone will pay.
Whatever someone will pay. So there is no maximum. from my standpoint, right? So the minimum, and then there's no max, for me. So now, I'm the buying guy. What is the minimum I will pay?
Budgeted, I guess.
I take it for free if he'll give it to me, right? I have no minimum. Because I need the ball bearings for what I'm manufacturing. So if he'll give it to me for a penny a ball bearing, I'll buy that. Then my profit goes up by whatever I would have had to pay less the penny, right? So I have no minimum. What's the maximum that I'm gonna pay?
Whatever the minimum would be that you could pay someone else.
Let's say that we haven't got an external source.
Covering all the expenses.
What was it?
You are, yeah, going in the right direction. So let's say I've got a selling price, right? Let's say I can sell the wheel, let's say I make wheels. And I can sell my wheels for $10. And my variable costs, without including this, are $4. So my profit is equal to $6 minus what I pay for the ball bearings. So assuming that I will still buy the ball bearings if my profit is equal to 0, what is the most I will pay for the ball bearings? $6. And that is my selling price minus my variable expenses, or my profit without that transferred thing. So profit not including transfer, good. Okay, so what we've said is that this transfer will take place as long as the price, so the transfer will take place if the transfer price falls anywhere between $2 and $6. So, what is my profit as the selling agent, selling department, if the transfer price is $3? What is my profit as the seller if the transfer price is $3? What is it? If the selling price, if the transfer price is equal to $3, my profit is equal to, what's my profit?
$1
It's $1 per unit. Okay? As the buyer, if I pay $3, then my profit is 3. So the profit's always going to be some, pardon?
No, but I was just doing the buyer when you were the seller.
It's okay. So the profit is always going to be $4, as long as it's between this. What happens if the transfer price, if the seller insists he needs to get $7? The transfer won't take place. So, that's that's what happens when there's no constraints on capacity. So at the top of page 487, when it says selling division with idle capacity, that's where it's going. It's, it uses a strange little formula there, which basically says 0 over 2,000. The reason, on page 487 in the learning aid. Sure. So what they've done is that 0 over 2,000 is the actual formula that they use underneath there, which is selling division with no idle capacity. So let's talk about that for a second. So if this division can make as many ball bearings as they want, and these guys can take 50,000, then these guys will give them 50,000. If these guys are already selling all of their ball bearings and they have no idle capacity, so let's say that they can make 100,000 ball bearings per month, and they are making and selling 100,000 ball bearings. Let's say that they are selling them to external customers for $7 a unit. What is the minimum selling price that these guys will take? $7, because they are selling them for $7 now. And how much profit are they making at $7? $5. So this seller will not agree to transfer them at $7. Let's say that overall the company will make a profit of more than $5 if they do the transfer. Then what you were talking about is actually the case, where based on the seller and the buyer's different needs, they won't make the transfer, but the company would be better off if they did. So there is a formula here that helps you calculate what the transfer price would be if a division had no idle capacity. Do they have, oh yeah, this Cumberland Beverages on the bottom blue square. Ugh, 10 minutes left. So you're going to want to do these transfer pricing questions so that you can do them, because there will be some on the exam. So they've given you an example on the bottom there where they say Cumberland Beverages. Harrison Limited owns fast food restaurants and snack food and beverage manufacturers, and one of its restaurants, Pizza Place, serves a variety of beverages along with pizzas. One of the beverages is ginger beer, which is served on tap, and he has just purchased a new division called Cumberland Beverages, which produces ginger beer. So the managing director of Cumberland Beverages has approached the managing director of Pizza Place about purchasing Cumberland Beverages ginger beer for sale at the restaurants instead of its usual brand. So the managers at Pizza Place agree that the quality of the ginger beer is comparable, so it's just a matter of price. And then they give you that box of information. So they're telling you that their production capacity for the ginger beer is 10,000 barrels. The variable cost is $8 per barrel, and their fixed costs are $70,000 a month. And the selling price of the ginger beer on the outside market is $20,000 a barrel. Oh, $20,000. That's a lot of money for a barrel of ginger beer. $20 per barrel of ginger beer. So whenever you get information about transfer pricing and they're operating at capacity, they will always have an outside market, right? Because otherwise they wouldn't be at capacity. So they say here that the transfer price is going to be the variable cost of the unit plus the contribution margin lost on the lost sales over the number of units transferred. So if you look at how this works, they're saying, we already talked about the seller's perspective, how the transfer price is, I don't want to rush through this. Oh, sorry. So the information is that the variable price of the ginger beer is $8, right? And the external price is $20. So it says the selling division only wants to do the transfer if the profit increases. So clearly it can't be below the $8, which we already talked about. So the minimum price is $8. And remember, the minimum transfer price in a perfect situation is never below the variable cost of the thing that's being transferred. So the minimum transfer price is $8. So now the question is, what's the maximum transfer price? And so the maximum transfer price, okay. They do a lot of talking in here, it's very confusing. So the variable cost plus the total contribution margin lost on sales. They actually give us an instance of how much they want to buy. They want to buy 2,000 barrels. Okay. So the number of units they would want to buy is what they're, you see the pizza place says they use 2,000 barrels, so they're looking for 2,000 barrels. Because what we're actually calculating here is a per unit amount. And so when you, like this variable cost is a per unit amount. Because the transfer price is per unit. So what we're going to try and do is figure out how much they are giving up if they make the transfer to the restaurant. So they're transferring 2,000 barrels. So if we're doing a unit thing. So the total contribution margin that's lost. So if they are operating at capacity, then they are, which one have they done here? Maximum transfer price, minimum transfer price. Yeah, they can get $20 a barrel from selling it on the market. So that's this external selling price here, right? So the contribution margin, if you remember, is selling price less variable cost gives you contribution margin. So for these guys, the selling price is $20, their variable costs are $8, so their contribution margin is $12. So their total contribution margin is 20 minus 8, which is 12, divided by the number of units transferred. So whatever 12, well actually times, this would be times 20,000, would it not? Where is it getting the 1,000? Was it trying to tell you that it has room for 1,000?
2,000 units.
No, it's saying it wants to transfer 2,000. Oh, we're looking at there, yeah, 2,000. So the 2,000s, cancel out, right? So what happens is the variable cost plus the $12 of contribution margin that they lose means they won't sell it for less than 20, which is because you didn't actually even need to do all that. Basically, if the seller has an external price, they won't accept a price less than the external market price. Same story, if the seller can buy it, if the buyer can purchase it externally, then the most they will pay is the external price they can buy it at. So if, for example, these guys can buy the ginger beer for $22 a barrel on the market, they would be happy to pay $20. If they can buy the ginger beer for $18 a barrel, they will not do the transfer because they can buy it cheaper outside. However, this is the actual instance that Tammy was talking about. If they can buy it externally for 18 and these guys can sell it for 20, is the company ahead if they make the transfer?
No.
Well, what's
Well,
the
it depends,
contribution
because
margin?
They're gonna make more by selling it externally. But
Yeah, realistically, they will end up it won't make, these guys will pay $2 more. These guys will get $2 less. So the $2 evens itself out. Usually though, what happens is when you have an internal transfer, there will be other savings that can be realized. So for example, on an exam question that I had to write as a student, if you did the internal transfer, you could save $2 on packaging costs. Well, in this example, you would then be ahead by $2 per unit, right? So overall, you may be ahead.
But it depends on internally where you're sending it to. You might have other internal costs that you have to cover then.
Yeah, but in a question it would say, you'll incur this or you'll save this. It will never be that complicated. But yes, you could, but we don't have questions that are that complicated. So where are we? And then, okay, so then if they have so you see there's 3 breakdowns on 487 in that beige box. There's basically, if they can manufacture as much as they want, then this doesn't come into play at all. If they have no idle capacity, then basically it's the external selling price. And if they have some idle capacity, that's where this actually comes into play. Because then what you do is, if they have some idle capacity, say they could make 1,000, they have room to make 1,000, but these guys want 2,000, then they're going to be ahead on the 1,000, but they're going to lose this contribution margin, not on 2,000, just on the 1,000 that they could have sold for 20. And you'll notice that this is a different number. So now the seller would actually agree to do that for $14. So for $14, now they would make the transfer because they've got capacity to make this much. Okay, so definitely read up on that. Do lots of questions.